Hello and welcome to this presentation on Houston Wire and Cable Company. This presentation accompanies the Spring 2013 Burkenroad Report on Houston Wire and Cable. I am Alex Kronberger, and I served as an equity analyst in the research and writing of this report. The other analysts on our team are Aditya Srinivasan, John Abraham Francis, Mayan Kong, and Vanil Reddy. Andrea Durham Blanca was the investment research manager for this report. Today we will give you an overview of the company, Houston Wire and Cable, then discuss the industry that Houston Wire and Cable operates in. We will then give an overview of the corporate strategy, discuss our investment thesis, and then proceed into sections of our report including peer analysis, risk analysis, financial performance and projections, and we will finally conclude with our valuations and target price for Houston Wire and Cable. Houston Wire and Cable distributes specialty wire and cable products and related services to end markets primarily in the continental United States. Houston Wire and Cable trades on the NASDAQ Stock Exchange under the ticker HWCC. The company serves the U.S. industrial market as one of the largest distributors of electrical and mechanical wire and cable. With headquarters in Houston, Texas, and additional distribution facilities across the United States, the company offers clients a single-source solution for electrical and mechanical wire and cable. Houston Wire and Cable holds a position in a niche sector of the electrical distribution and wire and cable markets in the United States. In 2011, the electrical distribution industry tallied $86.9 billion in sales, nearly $60 billion of which was collected by the industry's 200 largest companies. The wire and cable industry is heavily affected by a number of macroeconomic factors such as interest rates, GDP, consumer price index, government spending, and shipping costs. These forces contribute to both market demand and the profitability of the entire industry. The recent 2008 recession affected the industry more profoundly than any other economic or political event since Houston Wire and Cable began operations in 1975. At the same time, circumstances such as reductions in interest rates and periods of long-term political stability allow the industry to grow and expand. You can see here the 5-year stock price for Houston Wire and Cable. Our publication date for the Spring 2013 report was March 19, 2013. At this time, Houston Wire and Cable traded for $12.79. The 1-year range of this stock was $10.32 to $15.09. Houston Wire and Cable's long-term strategy focuses on solidifying its position in 3 target markets: the utility, industrial, and infrastructure end markets. In the utility market, Houston Wire and Cable offers several products used in power and electricity production. New activity in this market has the potential to expand with the growing demand for clean and alternative energy production facilities. In the infrastructure market, Houston Wire and Cable plans to continue expanding its presence in transportation, water management, and other untapped sectors over the next decade. The company's current goal includes growing its customer base, more specifically for high-value projects. In many high-value projects, specifically in the energy sector, electrical wire and cable needs constitute approximately 3% of the project cost. Houston Wire and Cable plans to serve this niche sector by partnering with its existing distribution channel. The main risk associated with this approach is increased revenue cyclicality. Our investment thesis is based on the following 4 points. Houston Wire and Cable benefits from both onshore and offshore oil and gas exploration. The Eagle Ford shale play in southeastern Texas provides a strong revenue opportunity for Houston Wire and Cable. The Eagle Ford shale play is the world's most active shale play and currently has over 240 operating rigs. Houston Wire and Cable is affected by significant fluctuations in commodity prices. Changes in the costs of commodities such as copper, steel, and other key wire and cable components have a strong correlation with the company's margins. Commodity prices also impact the value of Houston Wire and Cable's inventory. The utility, infrastructure, and industrial markets are expected to grow moderately in 2013. Establishing a foothold in new energy sectors is a long-term growth opportunity for Houston Wire and Cable. The company is positioned to benefit from the proliferation of new power technologies across the U.S. energy portfolio. The acquisition of Southwest Wire Rope and its subsidiary Southern Wire expanded Houston Wire and Cable's product mix to include mechanical wire rope slings, nylon slings, and other related hardware. This expanded product offering provides the company with access to new markets. Industrial markets such as construction and oil and gas offer growth opportunities because of their demand for mechanical wire ropes and slings. Diversifying its product mix through acquisitions makes Houston Wire and Cable's margins less susceptible to external factors such as commodity prices. Houston Wire and Cable operates in a highly competitive and fragmented market with limited opportunities for differentiation. Many of Houston Wire and Cable's competitors operate locally and are privately owned. The company's peer group also includes larger suppliers and manufacturers. We selected the following peers: General Cable Corporation, Coleman Cable Incorporated, Annixter International Incorporated, and Wesco International Incorporated. These peers offer similar products and services to those offered by Houston Wire and Cable, and they operate in the same market. Houston Wire and Cable has a small market capitalization of $212.7 million and a low earnings per share of 89 cents. The company's dividend yield of 3.02% is relatively higher than that of its peers. This indicates that the company pays out earnings quite generously compared to its peers. The debt-equity ratio of 64.53% is lower than the average. Although this ratio is considered a good indication of Houston Wire and Cable's solvency capacity, it also raises some questions about whether the company can efficiently finance its operations in the future. In addition, a lower than average return on equity of 15.49% indicates that the company may be less profitable compared to its peers. This may be because of the increased inventory levels at Houston Wire and Cable in recent quarters. Houston Wire and Cable faces risks that affect the entire electrical distribution industry. The company also carries risks that are specific to its market position. These risks are attributable to the company's regulatory, financial, and operational activities. Much of the risk tied to end-user demand is compounded by the cyclical and irregular capital spending trends in industries affecting Houston Wire and Cable's revenue. Houston Wire and Cable's market position as a specialty wire and cable distributor mandates that the company maintain high levels of inventory to remain competitive. These high levels of inventory, which included approximately 36,000 unique stock-keeping units in the second quarter of 2012, create a significant asset value risk for Houston Wire and Cable. Natural disasters such as hurricanes, earthquakes, and other extreme weather conditions can create risk for Houston Wire and Cable because of the potential to damage or destroy unsold inventory or product that is in transit to or from at-risk areas. A large degree of Houston Wire and Cable's operational risk is correlated with external forces that affect the company's operational efficiency and capacity. One of these risks is the possibility of suppliers changing their product rebate policies. Industry regulations pose moderate known risks to Houston Wire and Cable. Houston Wire and Cable has been named in a number of lawsuits concerning certain types of wire and cable containing asbestos that the company distributed. However, overall, the company's liability risk remains somewhat low. Houston Wire and Cable has the strongest current ratio among its peers, which is 5.3. Houston Wire and Cable's loan agreement with Bank of America provides for a $100 million revolving credit facility to support its working capital requirements for future growth. Any excess cash generated from operations is used to pay down the revolving debt. Houston Wire and Cable faces a certain degree of external credit risk in regard to the company's customers. The company's financials are exposed to market risks arising from changes in market prices, such as changes in interest rates and commodity prices. According to Houston Wire and Cable's 2011 10K report, management believes that changes in interest rates would not have a significant impact on the company's overall financial performance or operational results. Houston Wire and Cable's Z-score for 2012 is 6.68. Looking through the Z-scores for Houston Wire and Cable from 2011 to 2012, the consistently high Z-score indicates that the company is not at risk for bankruptcy. In forecasting Houston Wire and Cable's financial performance, we use certain macroeconomic and industry-specific assumptions. We made these assumptions based on past trends and Houston Wire and Cable's historical performance and company policies. This table shows the projections for sales and cost of goods sold for the next 3 years. In forecasting investing activities, we assume that Houston Wire and Cable will not make any new acquisitions in the near future. In our regression model, we assume the inventory levels will grow at 2%, which is in line with inflation and the increased product line offerings made by the company. Despite assuming inflation to be at 3%, our team selected a growth rate of 2% for inventory because the company endeavors to optimize inventory levels and increase inventory turnover. In forecasting operating activities, we assume that Houston Wire and Cable will not incur any significant changes in property, plant, and equipment expenditures in the next year. In terms of financing assumptions, we assume that Houston Wire and Cable will be profitable enough to pay dividends of 36 cents a year. Our team also assumed that the company's debt will remain constant at $58 million. As a result, we expect the debt ratio will decrease from 29.72% in 2012 to 12.66% in 2022. Given that we assume the same debt level of $58 million in the forecasted period, we kept the interest expense constant in line with current interest rates. We project a one-year target price of $18 for Houston Wire and Cable. We arrived at this price by taking a weighted average of the discounted cash flow model and relative multiple valuation models. The basis of the discounted cash flow model is to estimate a company's future free cash flows discounted to the present. We used a risk-free rate of 2.79% and a market risk premium of 6.72% and a beta of 1.54 to get an after-tax weighted average cost of capital of 10.73%. Using a 10-year prediction period and a terminal growth rate of 2.79%, we arrived at a target price of $21.82. In using the relative multiple method, our team has considered General Cable Corporation, Annixter International Incorporated, Wesco International Incorporated, and Coleman Cable Incorporated to be comparable to Houston Wire and Cable. The price to earnings multiple gave us a target price of $15.21. The price to tangible book value multiple gave us a target price of $11.19, and the price to cash flow multiple gave us a target price of $14.21. Based on these multiples and the discounted cash flow target prices, we arrived at a target price of $18, which is $5.21 above Houston Wire and Cable's current market price. Thank you for viewing this presentation on Houston Wire and Cable Company. The Burkenroad reports are produced solely as a part of an educational program of Tulane University's Freeman School of Business. The reports are not investment advice, and you should not and may not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment. Thank you.